Welcome to Texas Examination for Life and Health Agent Examination. Chapter 2. Types of Life Policies. Term life insurance. Purpose. Temporary, pure protection, no cash value. Types. Level term. Death benefit constant. Annually renewable term ART, death benefit constant, premium rises with attained age. Decreasing term. Death benefit decreases, often used for loans or mortgages. Return of premium. ROP. Returns all premiums if insured outlives term, not taxable. Key features. Renewable. Extend term without proof of insurability, premium based on attained age. Convertible. Convert to whole life without evidence of insurability, premium based on attained age. Whole life insurance, permanent. Purpose. Lifetime coverage and cash value accumulation. Characteristics. Level premium and level death benefit. Builds cash value that equals face amount at age 100, policy endowment. Has living benefits, including loans, withdrawals, non-forfeiture options. Forms. Straight, ordinary life, pay premiums to 100 or death. Limited pay life, 20 pay LP 65, higher premiums paid up earlier. Single premium whole life, one lump sum, immediate cash value. Flexible premium policies. 1. Adjustable life. Can switch between term and whole life. Flexible premiums and face amount. Cash value grows when premiums exceed cost of insurance. 2. Universal life. UL. Flexible premiums, minimum or target. 2 death benefit options. Option A. Level death benefit. Option B. Increasing death benefit, face and cash value. Cost of insurance deducted from cash value. 3. Variable life and variable universal life. Investment-based, separate account. Cash value and death benefit vary with investment performance. Requires both securities and insurance licenses, SEC and FINRA. 4. Interest-sensitive whole life. Premiums adjusted based on current interest rates. 5. Indexed whole life. Cash value tied to stock index, for example S&P 500, with guaranteed minimum. Combination policies. Joint life. First to die. Pays at first death based on joint average age. Survivorship life. Second to die. Pays at last death, lower premium, often for estate planning. Annuities. Purpose. Provide steady income for life. Protect against outliving money. Not life insurance. It liquidates an estate. Phases. Accumulation. Pay in, owner deposit money. Annuitization, payout, insurer pays income. Parties. Owner holds rights, can be a trust or corporation. Annuitant. Receives income. Must be a natural person. Beneficiary. Gets remaining value at annuitant's death. Types of annuities. By premium. Single premium, lump sum. Periodic premium, payments over time, flexible or level. By when income starts. Immediate, SPIA, payments start within 1 year. Deferred, payments start after 1+ years. By investment. Fixed, guaranteed rate and payments. Insurer's general account. Variable, separate account, no guarantees, requires securities license. Indexed, interest linked to index, for example, S&P 500, guaranteed minimum. Payout options. Pure life, straight life, income for life, no refund. Life with guaranteed minimum, refund if death occurs early. Cash refund or installment refund. Life with period, certain, income for life and guaranteed period. Joint life, stops at first death. Joint and survivor, continues for surviving annuitant. Annuity certain. Fixed period, pays for a set time. Fixed amount, pays fixed sums until funds are exhausted. Test tips summary. Term insurance. Temporary, no cash value. Whole life. Permanent, builds cash value. Universal life. Flexible premiums, option A and B death benefits. Variable life. Investment risk on policy owner. Separate account. Annuity. Liquidates estate, opposite of life insurance. Fixed versus variable annuity. Guaranteed versus market-based returns. Joint life versus survivorship. First to die versus second to die payout. Term life insurance. What type of protection does term life insurance provide? Temporary pure death protection with no cash value. What happens to a term life policy at the end of the term if the insured is still alive? The coverage ends with no payout unless renewed or converted. How are term insurance premiums affected by the insured's attained age? Premiums increase upon renewal because they are based on the insured's attained age. Whole life insurance. What type of protection does whole life insurance provide? Permanent protection for the insured's entire lifetime to age 100. What unique feature does whole life insurance have that term insurance does not? A cash value component that grows on a tax-deferred basis. At what point does the cash value of a whole life policy equal the face amount? At the policy's maturity, typically when the insured reaches age 100. Universal life insurance. What makes universal life a flexible premium policy? The policy owner can adjust the amount and timing of premium payments. What are the two death benefit options available under a universal life policy? Option A. Level death benefit, face amount remains constant. Option B. Increasing death benefit, face amount and cash value. If a policy owner skips a payment on a universal life policy, what happens? The insurer deducts the cost of insurance from the policy's cash value. The policy remains active as long as enough cash value exists. Variable life insurance. In a variable life policy, who bears the investment risk? The policy owner. Where are the assets for a variable life policy held? In a separate account, not the insurer's general account. What licenses must an agent have to sell variable life insurance? Both a life insurance license and a securities license, registered with FINRA. Joint life versus survivorship life. What does a joint life policy pay out on? The death of the first insured first to die? What does a survivorship life policy pay out on? The death of the last insured, second to die. Which policy has a lower premium, joint life or survivorship life, and why? Survivorship life, because the death benefit is not paid until both insureds have died, extending the life expectancy of the policy. Annuities. What is the main purpose of an annuity? To provide a stream of income that cannot be outlived, protection against outliving one's money. How do annuities differ from life insurance in purpose? Life insurance creates an estate, pays upon death. An annuity liquidates an estate, pays during life. What are the two main phases of an annuity? Accumulation period, owner pays in. Annuitization period, insurer pays out. Fixed versus variable annuities. Where are fixed annuity premiums invested? In the insurer's general account, safe conservative investments. Where are variable annuity premiums invested? In a separate account, stocks, bonds, or mutual fund, like investments. What is guaranteed in a fixed annuity but not in a variable annuity? A minimum interest rate and a guaranteed payout amount. Joint and survivor, payout options. What happens under a joint and survivor annuity? Income continues for two or more annuitants. Payments may be reduced for the survivor, for example 1/2 or 2/0. Which annuity payout option provides the highest monthly income? Pure life, straight life, because it pays for life with no refund guarantee. What payout option guarantees that the entire principal will be paid out? Life with guaranteed minimum, refund life. Refunds the balance to a beneficiary. What's the difference between a fixed period and a fixed amount annuity? Fixed period pays for a set time, regardless of whether the annuitant lives. Fixed amount pays a set dollar amount until funds are exhausted. Thank you for participating and good luck to your exam.